Okay, this is chapter 8 over here. These are dangers of pension liabilities. Now, pension liabilities are something which the company has to pay for their employees, but how do you find them? How do you understand them? And what are the implications they can have on your profits and your return ratios? So, this chapter is meant for that. See, again, these are UK's book, and UK things are something different than Indians. So there are more liabilities that are in front of the investors. The less money they are entitled to, and the more risk and investment in the company with this. So this pension liabilities must be paid to the shareholder, to the employees. And this is before the shareholders. We poor shareholders get the last residual profits of the business after this interest payments, pension liabilities, and all these kind of things. Due to variety of reasons, lots of corporate pension funds have significant funding shortfalls known as deficits. Yes, they are deficits, and there are lots of assumptions also. We'll see that going ahead. These pension funds may not be sufficient to pay for the future pension of the company which they have promised to their current employees. So, what this happens is the company has to find cash to pay these pensions if they are in deficits. So, what are the three types? Defined contribution or money purchase schemes, defined benefits or final salary schemes, defined contribution or money purchase pension scheme. How do you see all this? The amount of money to be paid into the fund, the pension fund, by the company is not defined. A fixed amount which has to be paid. This is usually a percentage of the employee's salary. This is known as the cash cost for the company, and it reduces its profits and its cash flows. For the defined benefit or final salary scheme, these pension funds are more problematic for companies. This can end up being a very large sum of money, and it is not easy for a number to work out on. These pension funds can become a big problem for companies when the amount of money they have set aside, pension fund assets, is less than the pension fund liabilities in the long term, right? So what they do is they take the present value of future pension obligations, and they keep on making these assets where they have to use these assets when the pension liabilities have to be cleared. If the deficit is large, a company may have to cut its dividends, which generally companies do, to pay these pension liabilities. So here is given an example of BT's final pension scheme. These are the numbers of the business. The 7.6 billion pounds deficit had been reduced by a deferred tax asset on 1.5 billion pounds. But how do you find this in the first place? This is what are you seeing about here? Okay, now what he does? He does take up BT's 2015 annual report. These are the assets in million of pounds, and these are the liabilities. This is the deficit. Liabilities are more than the assets. So he includes all the interest payments, settlements, and all these things, and we land up on a deficit of 549 million pounds. Return plan and obligations going in and out, in and out, in and out. So these are the movements of calculations, foreign exchange, and basically what the company is saying, we have adjusted cash flow of 1054 crores after paying all these liabilities. You can do this by looking at the notes of accounts. The pension obligations will be given to your annual report, and you'll have to adjust your cash flows for that. Now, what are pension funds? Now, these are the funds. This is the market value for the investments of shares and bonds which they have invested in today or made a fund today, which the fund will become the asset which will clear the liabilities when these pensions will have to be paid. So how do you get this? The actual estimates. See, I told you these are estimates. What will happen in the future? Nobody knows. These are estimates of annual investment returns. Price changes plus income tax receipts are dividends. Income receipts are dividends. This is expected to be this and this for this business, and the calculation for this business. So these are the assets. They invest in bonds, they might invest in their own stock, they might invest in some other companies, and they assume that this is the income we're going to get, and this is our pension asset which is going to be bloated to XYZ number. So when the liabilities are paid on, we'll be able to pay from this. But markets are going up and down every day. This can change anytime. So pension fund liabilities are the liabilities which they put on their balance sheet. The rate of increase in workers' salaries, when the workers will retire, what proportion of their final salary will be paid, how long they will live after they retire. These are all assumptions. The rate of inflation in the future. 5 is assumptions which the companies has to work in. A liability worked out each worker, then all the liabilities will be added together. Again, big headache where the business has so many employees. Then they use a discount rate. Again, this is an assumption, DCF kind of a thing. I'll have to pay 100 crores going forward. Then how much should I invest and what rate should I grow? So I get 100 crores when I have to pay these liabilities. I don't know the future number. I don't know the what rate it will grow. So I can discount 100 crores say by 10%, 15%, 12% back to today's rate. So to get a startup number, how much should I invest and into what assets? A mix of debt, a mix of equity or bonds or one other thing. So these are again examples. He discounts, he produces this 10%. All this is the same thing over here. Then what we have final salary pension schemes 2015, 13, 14, 15. See, defined benefit schemes and defined contribution plans. This will also be present in our Indian companies annual reports. Again, this BT. How this impacts your cash flows? You'll have to add or subtract, basically subtract from your cash flows to get these things. Future funding obligations of recovery plan, another type of a pension only, hospitalization or what the company plans to give. So basically, don't get too muddled or too confused in this. This will depend upon company to company, case to case, and number of employees, and the CSR activity which our companies have to do. So this is again free cash flow per share adjusted for dividends. What are the dividends they have given? So the balance after paying the dividends is what the free cash flow per share. We have to set our pension assets which we can use to retire the pension liabilities when the when the employees retire. So how do you identify big pension problems? This section is that pension fund deficit, market cap, different companies examples. Pension fund deficits for the investor. What are the questions we need to ask for all this? Does the company have enough free cash flow to plug in the hole in the pension fund and still have enough money to left over to pay dividends? A very big question. Take the size of the deficit and divide it by 10. Most pension funds deficits have to be closed over 10 years. This calculation will tell you how much extra cash the company needs to pay into the pension fund. So BT with a 7 billion shortfall, it should be paying extra 700 million a year for the next 10 years. Now adjust this 700 million a year in your profits, in your cash flows. Is the company paying this? BT looks like it's having paid 875 million last year. Other companies might not be paying. This company is paying. Chalo, good. If a company looks like it isn't paying enough to reduce the deficit, work out how much the extra payments would reduce the company's free cash flow and then compare it with the cash cost of company's dividend. Don't pay the dividend, but you take care of your employees first. This is what the management should do. Look at the sensitives of the pension fund to changes in assumption of interest rates. See discount rate, at what rate it will grow, future inflation, life expectancy. All this has much of assumptions. Now one person's assumptions can be different from different person's assumptions. So how do you look at companies which are dangerous companies? Debt to net operating cash flow, debt to free cash flow, debt to total assets. These are the numbers which you should look. Debt to total assets, interest cost coverage, fixed charge cover, pension funds, what are types of pension fund, and avoid large amounts of debts repayable in 1 year or less, because then the debt has to be paid, the pension has to be, the equity shareholders get nothing. So we equity shareholders are the last one in the queue. So next part is how do you value company shares, should be very interesting. Let's go ahead.